Luke, how are you going?
Good afternoon, Professor Rask. How are you, mate?
Good, mate. Good. Ben, how are you?
Good, Owen. Thank you for having us again.
Yeah, thanks for taking a trek down. So today we're going to talk
All
about...
of 2 blocks.
Yeah. It's a long way.
Yeah.
We're going to talk about 3 companies, all small caps, all really interesting kind of catalyst-driven businesses. So if you're in the market for companies, and one of those being XRF, which was requested by the Rask community, we're going to talk a bit about those today, and also just kind of the lessons learned and learnings for all investors behind them. Luke, starting with you, one question that we've been asking a lot of people lately. You guys specialize in small cap investing. You do all types of investing, but small caps is what we're talking about today. Do you think ETFs and index funds increase the value proposition of small cap investing?
Yeah, I think they do. I think it's twofold. I think there's the index calculation method or methodology, which, includes a lot of relatively small, often overhyped pre-revenue businesses in the bottom of the index that make an appearance for a period of time and then drop out, detracting from returns. And, the occasional REA type business or zero, which is in the small ords, but eventually goes from being company number 101 to 100 to 99 to 98 in the index and graduates out of the ASX Small Ordinaries Index, and also, investors in ETFs miss those returns as well. So from those kind of category killers or, structural growth trends that actually do go on to become multi-billion-dollar companies. So the index is a bit flawed, and that's why over the last 5 years, the average manager beats the index by 5 or 6%. Yeah. So in small. So, you are definitely hunting in the right ground for an active manager if you're looking at small caps, Australian small caps. I think there was a good article from Morningstar about explaining why they think Australian active small cap managers are outperforming so consistently. I won't maybe bore everyone with the details of that, but I'll link you the article, and great. You guys can go and read that for yourself. I think the second component is more of a Luke's opinion, less data and evidence, but my gut feel for it is that more and more money is investing. Instead of investing as a principle should be that we find the best businesses, the most efficient businesses, the fastest growth businesses, the highest productivity businesses, and we invest more capital in those. Well, now most people, I would say, are investing in index funds and passively, and therefore they're not allocating to the most productive, they're just allocating to the biggest. So most money goes to the biggest, second most money goes to the second biggest, so on and so forth. And I think that's an inefficient way to allocate capital, and it's creating inefficiencies in the way that the stock market works, both here in Australia and around the world. And as a result, there are small businesses that are not receiving the capital or reducing their cost of capital at the rates they should be, the rate of change they should be, or historically have. And so that creates these situations like we've seen with Catapult, say, for example, which we've owned from less than $2 a share, where all of a sudden it goes from $2 to $3, and then from $3 to $6. And the reality is that it's just a lot of money from index funds all of a sudden chasing a stock because it's going to get included in an index. I think EOL, ASX 300 now as well, it's gone from $10 or $11 to $15, $16 in the space of, I don't know, like 3 trading weeks or something like that, all because index inclusion and now the weight of money is chasing it. So there is a lot of alpha on the table for active managers to go and chase. And so I think for those 2 reasons, investing in index funds for ASX smalls exposure is structurally disadvantaged.
And so you felt that over your career?
Yeah, for sure. I think it's getting worse and worse and worse. It makes large cap investing, you can be wrong for a lot longer. And it means when you are right, you make a lot more money.
Yeah, interesting. Ben, anything to add?
I'll just sort of echo those thoughts with some of the smaller cap names where a lot of the best returns are made before they get into the index. Luke mentioned a couple there, but Objective Corp is another one, which is just like we've spoken about it with you, Owen, before. And recently, the last couple of weeks, it's kind of just been going up pretty consistently on no news flow. And, you could think, it's coming up to reporting season, maybe it's going to report well. Well, no, the simple answer is it's just the quantitative analysts out there think that it's going to be included in the ASX 300 index. and that's going to be a big passive buying catalyst for it. So plenty of inefficiencies for us to exploit, I think, and that'll be sustainably so.
Yeah, really interesting. What about then? Maybe it's just, this is a separate question. Maybe back to you, Luke. Do you ever think about more companies staying private for longer?
Do I ever think? Have I ever thought about it? Yeah, I have. Do I think it creates more efficient pricing mechanisms? No, I don't. I think people are gaming index investors. So whether you are a company that's listed already and reconstructing an otherwise tightly held ideal share structure into a less ideal share structure instead to work best for index investors rather than individual investors or private investors or active investors can create incentives that aren't necessarily perfectly aligned with what we want when they go into a company. Sorry, go on, mate.
So you've done a lot of like corporate action style work, like you've like seen companies list, like IPOs, you've seen transactions take place and all this sort of stuff.
Yep.
Is there anything in the back of your mind, like just thinking about the persistence and the sustainability of the small cap ecosystem, so to speak, do you ever think like, oh, there aren't that many good companies IPOing, or do you ever think that you run into a problem where there's not enough good companies to buy?
I think that is a problem. It's not a problem for us at Seneca. We're only needing to own 30 or so names. So there's enough stocks on the ASX for us to be able to find 30 really good companies to invest in. I think as you go up the larger cap end of town, and the stocks that are there because of these indexings are so expensive, it just incentivizes businesses to get bigger. So that like Sigma, perfect example, where it comes into the index straight away, they get that premium and that rush of capital straight away, and the people who are in there privately just make more money. So because it's not anyone who's actually assessing the value being offered by this business, it's just assessing, is it going to be inside the top 200?
Yeah.
And now the insiders are selling stock.
And now the insiders are dumping stock. And
the index funds are just...
And index are just gobbling it up like blindly. And yeah. So,
and that's your money if it's an ETF.
And that's your money if you're in an ETF.
So, is Sigma the one that did the Chemist Warehouse thing?
Yeah.
Yeah. So Chemist Warehouse got massive in private markets, relatively speaking, and then just jumped straight into ASX 200?
Big enough to get into the ASX 200, realised that people would have to buy it, and they'd have to buy it big, reduced, like Guzman and Gomez as well, is put out a very small amount of free float stock available and just played the we've got no stock, you need to buy it game.
Yeah, and then just pushes up the share price.
It's like, so it's stealing. Like it's just cheap, easy money. Like because they have to own it. So,
but we can only play the cards as they're dealt, and it does create other inefficiencies. Like an example going the other way is like PointsBet, which drops out of the 300. It gets smaller, it gets unloved, it just gets smashed. And then to your point, are we afraid of this, going to be less activity in that end because of that reason? Well, someone's just going to buy it is the answer.
And take it private.
Yeah. And so we can exploit that angle as well.
And they're going to do it again. So, I mean, if you're a small cap manager and this isn't a big part of your process, you're missing out on arguably one of the largest sources of alpha on the index.
It's funny because
on the market,
most people probably don't think like this, because you guys do, because you actually allocate money. You see where money has to go because you have to find the stocks to buy, like volume, you have to position yourselves and stuff. And then you're like, well, the rule of the game is the biggest stocks get bought more. So we just be at the beginning of that process or at the end when it comes the other way.
I wish it was that simple, but look, I think it's just another consideration. It's another thought. And when you're thinking about entry or exit, you have to be cognizant of these things because, it might get to your price target. I mean, I'm thinking about a couple of stocks in our portfolio right now where they've got to our price target. We think they're not cheap anymore. We think they're arguably overvalued right now. But we know the index funds are going to buy them. So we'd be crazy to be selling too much.
This is actually a side question that I had, which is like, what are some of the obvious mistakes that small cap investors make? So like, is paying too much attention to just valuation or just metrics. Is that a mistake that people make a lot, do you think?
No, I reckon it's not enough. Like, I think my overriding thoughts about the average person investing in companies is they spend too much time on narrative and macro, and this is going to happen, so therefore this company is going to win, and not enough time on valuation, what's in the price, scenario testing, and working out their position if things don't quite go the way they think they're going to go, and their margin of safety. I don't know, Ben, how did you sort of?
Yeah, I think it's just kind of building conviction where I think people, have one idea about just the general macro or the general, they've got customer XYZ, so they must be good. And then they just anchor everything back to that rather than continuously updating their thinking around a particular company. Kind of, if the drivers change for us, well, we're not afraid to be like, well, this company's got to go.
Yeah.
And, that's the kind of thing that we'll talk about stocks that we think are good buys today, but, in a year's time, they might not be good buys then, or they might be even better buys then. So it's just constantly kind of updating your thinking.
Well, that was going to be the other question I was going to ask you guys. Is like, how much do you think about macroeconomic factors? Because like, if you've got a view on like bank shares, basically the only insight that it seems that you could have is like, which one has better technology and what are interest rates doing? And that's like, because it seems like yes, like the data seems to suggest that in small caps, you're going to get way more premium. Like if you pay an active fund manager, you're going to get a lot better. Your
opportunity for alpha is more. Yeah, I mean, I think to answer your question, macro is not a huge part of what we do. I think forecasting macro is difficult. And I think if you've had like a win rate on forecasting, on making macro calls on stuff, you might not be doing that well. I mean, you can look at the bond pricing and the bond futures and be like, okay, well, that's my best guess of where yields and interest rates are going to go. But I mean, if you look at the success of that through time, it's actually not been the bond futures have not been a very good predictor of interest rates or bond yields. So I think, it's a bit of a fool's errand to try and worry about those things. I think what you've got to do is say, well, I want some exposure to interest rates. What are the best ways to get that exposure, and what's going to give me the most leverage for the smallest portfolio position size the best way to express that idea.
Yeah. Which actually is a really interesting segue into the first company, which is XRF. Because a lot of people think that this business is intensely cyclical. So I'm interested in, maybe I'll start with you, Ben, your thoughts on that. Like maybe just start with what is the business, but people wanted us to talk about this today. So what is the business? And then the second part of that is like what influences it?
Yep. It's definitely not as cyclical as you would first expect. And I can prove that to you. But just a quick overview on what XRF does. They've got 3 divisions where they sell basically lab testing equipment and consumables for your big lab groups like ALS, SGS, Intertek, those kind of guys, as well as the miners themselves and some industrial companies. So the reason why it's not as cyclical as you might first think is, mining, it depends if mining is going well or it's going badly. Well, the bulk of their profits actually come from these consumable chemicals that they sell, which once they sell a machine, and it doesn't have to be even their machine, it could be any machine, they are the dominant provider of these consumables. Both the chemicals and the platinum crucibles that get heated up to such high temperatures in the assaying testing that they've got to be replaced almost continuously. And they've got such a dominant market share. I think it was like 3 to 5 times
the next size of nearest competitor out of Canada, who they're actually winning work off in their home market of Canada. And that's the most profitable part of the business. So it's kind of one of these razor and blades models. Like I've been, ridiculed maybe for using this analogy in the past, but I'm going to bang the table on it again, which is Nanosonics. Like everyone loves Nanosonics. It's been a fundy darling from time to time. They sell these Trophon machines.
For
ultrasound probe cleaning, upfront capital equipment, and then ongoing consumables, which is the real profit cream. Now that trades on 4 times the valuation of XRF. What could explain that? Well, one is maybe healthcare demand versus mining demand, maybe. Another comes back to what we were discussing at the top, which is size and index inclusion, given that Nanosonics is, I think, over $1 billion market cap. XRF, sub $300 million market cap. And You know what else had a sub $300 million market cap until just recently?
What's that?
Energy One.
Energy One. Okay, interesting.
So this is actually a stock we've been buying recently.
Yep.
Which I can elaborate on.
Yeah, but 1 second before you do that buying thing, this actually does touch on another point that you raised, which is narrative. If you go, and everyone here has been for an ultrasound, I'm guessing.
Yeah.
Yeah, right? Been for too many than I would like to admit. And I always ask about the trophon, right? I never go in and be like, hey, what crucibles do you use in some sort of lab testing environment? Because no one has exposure to that. So it's not as easy to sell that narrative. I feel like if people understood it more, they would be willing to pay more for it.
But that's why, and even the cyclicality, like it's exemplary of how Ben and I and we have lots of different opinions about things and we argue about stuff all the time. And, but when it comes down to like fundamentally how we think about things, it's data, it's the evidence, it's like a scientific method, it's about objectivity. People will tell you that XRF is cyclical. That's what they will say.
Yeah, because it's mining.
Well, demonstrate to me the cyclicality in the earnings. Demonstrate it. Show me. Because as far as I can see, it's a line that starts in the bottom left-hand corner and ends up in top right-hand corner in a pretty much a straight line.
Yeah.
So I think these are the kind of opportunities that are very Seneca. It's very how we do things here. And perfect example when people start to talk to me about how things work and the reason why these big factors are influencing their decisions to buy or not buy stocks, when in reality there's just no evidence to support it.
You were going to say something about buying.
Yes. So
you've been buying recently, you were saying.
This stock has fallen, XRF that is, has fallen from just over $2. It had a good half year report in February. Fallen back to about $1.55-ish.
I reckon $1.55, $1.52, I think, low top of my head.
I've got it here. I can say $1.62, but it's up from $1.58.
There you go, $1.58.
Now, coming into the full year reporting season,
we bought more.
Worth having a think about what's going to drive that next leg up. One, you've got a really good management team who we've known for years and has historically delivered really consistently results-wise, who's just been buying on market as well.
I just saw that. That just pulled that up on my screen here.
Not much for the old Vancy boy. He needs to pull the checkbook out a bit more, I reckon.
But like, it's consistent.
He's good. He's good.
Consistent. And then if we look at data as well, because I think there was a bit of concern about a soft Q3.
Yeah, so, that's what it was, wasn't it? Yeah.
So there's two things. They blamed kind of just like sample volumes being a little weaker than normal, as well as some capital equipment that's been not invoiced until the June quarter. So let's see if that comes through, because often these small cap companies promise that there's delays. It's just always kicking the can down the road. But Vance and the XRF team has consistently demonstrated that, they can be trusted.
Yeah.
So let's see. I think it is. But the hard data here is that in Q4, sample volumes, if we look at the ALS result, have basically been, they were down a bit in 2024. They were up slightly in 2025. But the up slightly, 2.4%, was basically all in Q4. So they reckon that sample volumes have inflected in Q4, which means there's just more samples going through the lab, which means that XRF consumable and platinumware sales, we think, could do quite well in Q4.
So you're using one of their potential customers as a leading indicator.
We use their customers all the time. I think it's one of the best. SGS, ALQ, really good forward indicators for XRF.
Yep. For two reasons, because you can see the sample volumes reported, but also if ALS is doing really well, and ALS I'm particularly using because they're the leading commodities test labs, but if they get to a point where they need to put on a new lab, which they just raised money to do a new lab in, I think South America, Peru or something, they're going to need to get that
fitted out, decked out.
And who's going to do that?
Yeah. Cool. I like that.
So it's not complicated, this stuff, but you got to be doing it.
Yeah, you got to put in the work.
Yeah.
All right. Next company, speaking of mining, we've spoken about this a lot. RPM Global, ticker symbol RUL. I know we don't want to do too much buy, hold, sell type thing, but do you still like it at this level?
Yeah, I mean...
Because it has, since you guys have held it, it's done exceptionally well.
Yeah, we still like it. We still think no one understands it. And we still think relative to peers, it's probably one of the cheapest, decent software companies on the ASX. I think, that first XRF's a really good example, I suppose, of Seneca having unusually tight, good management access, being able to go to Perth, being able to get time with Vance. Ben's pretty much got him on speed dial. And, and when we ask a question on email, he gives us a really clear and transparent answer. And if we have a question about results, we can get time to talk about them. And, they're very, very good with us, and we really appreciate it. But this is probably a different example, RPM, where, quant screening tools, the average investor using an accounting reporting, ASX reporting software is not going to find this stock. It's going to look like this company is trading on 80 times or 100 times earnings, or EV to EBITDA, I should say. So it's a very unique one, because RPM Global do something that very few other companies do, and that is they expense all of their R&D costs. Now, most businesses capitalize their R&D costs. So if you cannot make that accounting adjustment and you do not know that exists, you will not pick up the correct adjusted EBITDA number for RPM Global. You will miss it on all your screens. It will look like it's not growing. It will look like it's not earning any money. It will look like it's got no free cash flow. And as a result, you'll miss it and won't buy it. And either will the quant funds who are chasing these stocks and who are competing with you every day. And so, that's why this thing still trades on 20 times, 22 times EV to EBITDA, and not 50.
A second string to the RPM bow more recently is they've sold the advisory division. So now it's a pure play software business, and you can, hand on heart, compare this business to your other software businesses on the ASX and comparable transactions, and figure out that it's still too cheap, even though it has run.
And to be fair, now that it is a very, very, very clean, orderly, straightforward takeover.
Yes.
$3.12, I think, is the current price-ish.
Yeah, it's got a good day.
Around that at least. We think $4 is probably the right price for this one, in a transaction.
I think $4 in a transaction is fair, and you're actually getting a good deal, especially if you're a software company and you can just bolt this in and get distribution, a bit like that Catapult deal this morning. Good product, already well used, well liked, blah, blah, blah. You just bolt it into Catapult, and now you can just supersize sales. And I think RPM Global would fit perfectly into a range of other potential pieces of software that would just help with distribution.
There was some other big acquisition in this space. It was a privately listed business. I can't remember the name of it.
Micromine?
Yeah, maybe it was that.
Yeah,
that was a good indicator.
Got done at 10 times sales, didn't it?
Big number.
But yeah, there's been a couple in the mining software space that have been done at probably 30-40% premium to, I'd say, RPM's current adjusted valuation.
And it would make sense that there's no advisory division anymore from a commercial...
Well, it makes analysing it easier for those simpletons who can't back out advisory business and do a basic sum of parts, and it also makes it simple for an acquiring company to just pay for what they want.
Yeah. Cool. Like it. The last one, know very little / nothing about, is VBX.
You will not know diddly squat about this, Owen Rask.
Who wants to go
Nobody knows
first?
diddly squat about this.
This
is a Ben Richards special.
Start at the top.
The defense, I'll let him go.
Okay. Go. First thing, bauxite. What do you know about bauxite?
Isn't that going to aluminium?
Correct. Yes, it's the precursor to aluminium. So iron ore is to steel as bauxite is to aluminium, roughly.
Stretch, but we'll take it.
And
that's a very Melbourne Collins Street.
You're talking to a guy from
that's
Perth over
the
here.
Collins Street analogy, but we'll roll with it.
Someone that really gets the hard hat on.
Yeah.
No, so the price of, obviously iron ore has been the golden goose, as it's referred to, for Australian miners. We've got a natural advantage in this country in terms of it's a stable mining jurisdiction, access to logistics and infrastructure, close proximity to China, and good grade of ore. So it's been a killer. But bauxite is kind of the ugly cousin that until recently has been pretty under the radar. Now, the price of a ton of bauxite has just eclipsed the price of iron ore a few months ago for the first time in a long time because there's basically a structural shortage of bauxite going into China. So China is where a lot of the aluminium smelting capacity lies. And in the same way that China has run out of domestically produced iron ore, so they've got to import it from Australia, they've also run out of domestically produced bauxite and have to import it from two places, Guinea and Australia. Guinea is a basket case, if I can use that term.
It is.
And just from
regrettably,
unfortunately.
They've got good grade ore, but in order to meet those production tons, they're having some real big issues in terms of just permitting and confidence in maintaining the projects for themselves.
As they say in Blood Diamond, TIA.
What does that mean?
This is Africa.
Okay.
You know?
Okay.
Right.
Yeah.
But Australia has also got some good mines, but mainly owned by like your Rio Tintos, your Alcoas, and they do a bit of vertical integration as well. Anyway, there's an IPO coming to market called VBX, which I've been tracking for a while now. When it was a pre-IPO company, we struck up a relationship with the management. We've been following it, got an allocation for this IPO. It should be listing in the next week or so.
From the time of recording? Yeah.
From the time of
recording. Because we are recording this a little bit in advance.
So potentially it might list after, it's got a great resource up in the northern part of Western Australia, which has the potential to produce super high grade, low impurity, which is really key in bauxite. It's 40 kilometers away from port. The managing director owns 50% of the company, wants to minimize dilution, so it's going to be nice and tight share register. And it basically ticks all the boxes that we look for, and it's kind of the same boxes that we use to identify Sun Silver, which is an IPO last year, which turned out to be the top performing IPO of the year, I believe. So let's see how it goes. We've done a lot of work on it and think it looks really interesting, but we'll leave that for the markets to decide when it starts trading.
Risks?
Risks, I would say environmental and permitting. They've done a lot of work there, but in that part of the world, it's no mean feat to get any project up and running. They also have some beneficiation that they do the ore. So just like basic kind of
bulk commodity processing / permitting / anything, want to dig up anything in the northern parts of Western Australia, you're going to need some Indigenous Aboriginal permitting.
Yep.
You're going to need some enviro.
Heritage.
You're going to need some enviro stuff done with fauna in particular up that way, and you might need road access, rail access, infrastructure, port access. So not going to be a problem for port quantity, but certainly you'll need a way to get it there to port efficiently. That being said, mining costs of this thing is going to be pretty low relative to the current price of bauxite. And we think if you like iron ore from Australia's good at digging up bulk commodities of stuff perspective, if you like, met coal and thermal coal dynamics, well, the steel complex has got far inferior supply demand sort of drivers. And when I say that, I mean it's got a lot of supply and demand's a bit meh because of China. Bauxite and aluminium is just the exact opposite. It's Hollywood. It's Christmas time. So I'd be, look, I think this is going to do really well. My view is that VBX is probably 70 to 120% undervalued at the IPO price. And I think that value gets realised super quick because it's got news flow, it's got stuff to do, they'll have the money they need to do it. And like Spence said, there's no shares on offer.
Okay, counterpoint. Why wouldn't they just get bought out now by something like a Rio Tinto or something like that?
Well, I suppose, all these companies going public would probably run a dual track process. And it's a question of whether they think the asset is worth. So they're floating at a market cap of 60, we'll say fully diluted market cap of 67, I think it is, for an EV of 57 mil. So it's a question of, do they want to minimize dilution, float now, add value, try and get this thing to 150, 200 mil market cap, and then they think they can be in production 2 years. So in 2 years, then they're faced with the choice of, do we sell it then or do we try and get into production? Is that the best value for shareholders, which is, Ryan, the MD, for himself? Or do you try and just take the quick sugar hit now, sell it for 60 to Rio and dust your hands and walk away from it? So I think this project is definitely something that could be of interest to those guys, but it's just a question of valuation and what they think it's worth.
I think it's super simple. So let's pretend Rio's happy to pay 100% premium, 50% premium, pick a number, right? Doesn't really matter. At a 60 mil value, 50% premium is only going to make you an extra 30. At a 500 mil value, it's going to make you an extra 250. So that's just the math, right? If you can get this thing to a higher valuation because you've progressed it from patch of dirt to PFS to financed or definitive fees, and then all you're waiting for is that last piece, and then you get a debt deal done and they go, well, your debt deal's on 8.5% weighted average cost of capital, and our weighted average cost of capital at Rio is 4.5%. We'll buy that, take the cost of capital arb, and by the way, we'll get rid of all your admin costs, and we already own the port, and we already own the rail, and we, blah, blah, blah. So I think, and then Rio catch all the synergies that they actually have without taking any of the development risk. And they've sold it for stock and, wedge of cash to the guys to keep everyone tied over. Like, it's not going to matter to Rio Tinto shareholders until it's producing. So that Rio Tinto shareholders are paying for profitable production tons. A VBX shareholder is paying to get it from zero to the point that it could potentially produce a profitable production ton. They're two different kind of drivers of value. Ben and I look, I hope VBX becomes a $50 billion company, but the reality is we won't be shareholders then. We just want to see it go from 50 mil to 500.
Yeah. Because you got a lot of experience in this type of, not just this specifically, but just mining in general and forecasting and that sort of stuff.
Yeah.
What takes a patch of dirt to 500 mil?
Hard work, bit of good luck, some good drilling, good share structure, good promotion and a narrative that you can build in the marketplace.
So they're raising, what are they raising? 10 mil?
Yep. Yeah, it's tiny.
What would that enable them to get done? Planning?
No, you do the use of proceeds, do it.
Yeah, I mean, you can check out, like in the prospectus, they'll obviously have to outline the use of funds, but they're going to do some infill drilling to upgrade the confidence of the resource, to take it from, a lower confidence, kind of inferred to indicated. Yeah. You get your reserve, which you wrap the study around. And then also the DFS. So they've done a pre-feasibility study, and then the final study you do before making your final investment decision to proceed with the mine is this definitive bankable feasibility study, and that's what you can get the banks to get behind and finance it, as well as raise some equity and do all those kind of things. So
you're taking it from, a PFS would be like a 60, 75% kind of confidence. You're taking it up to like 90 or 95% confidence.
And that's the thing for us. It's really just about de-risking it. So it's like there's certainly risks with this project, as there is with any project, but we're comfortable that the risks are being mispriced, I suppose.
Yeah,
and so that's where the valuation.
It doesn't matter that it's more quote unquote speculative. It's still the you guys
risk return.
Yep,
exactly,
risk return.
And then so that was going to be my final question on this. Is like, actually I've got two, but the second one's more like about good research for Seneca. But my final question on this is going to be like, how do you guys in Seneca position something like this?
Like we go hard at it. It's probably the short answer.
Well, I would disagree.
You guys are smiling.
I would say it's appropriately sized, which sometimes would go hard at something if we think that it's there's low downside and a lot of upside. But with this, I would say appropriately sized.
It's appropriately sized.
It's not the biggest position in our portfolio, but it's
nor is it the smallest. So we've cornerstoned this. So we're a pretty significant shareholder.
Yeah. Okay.
Significant for us.
Yeah.
It'll matter.
Yeah.
It matters. So, and look, I wouldn't be afraid of buying. If this thing trades 70 or 80 million bucks, 80 million market cap day one, I'd be happily to buy more. Would buy more.
Did you say it's 40 kilometers from the port?
Yes.
Yeah, it's close.
In size of the terrain of WA, that's very, very close.
Correct.
It's key.
So
bauxite's all about infrastructure. It's like iron ore. Like the reserves kind of, once you've got this low impurity Guinea style ore, once you know you have that, what you want Guinea style ore, not in Guinea, right? So
which is the thesis, really.
Which is pretty much our thesis here. This is Guinea style ore in Western Australia. So if you can do that and you can wrap around that resource infrastructure, a decent share structure, management, and a reasonable valuation, you are going to make a lot of money. Henceforth, we own it.
Yeah. Okay. Now, this is my final question. So people that are watching this or listening to this can get involved with the two of you one of two ways: invest with you, in which case we'll put all the deets in the show notes, your podcast player, but you can email Luke directly if you want to invest, learn more about the Small Companies Fund. But good research, and this is where the question of EBX comes from. Have you guys done a write-up? Like by the time this podcast goes to air, would people be or will it be coming soon?
It might.
Maybe at some point, but not for the IPO because it's almost irrelevant if you're a subscriber.
You can't really invest
Can't buy it. So,
and we might not like it if it goes up or, depending on how it trades. So all those recommendations are live to subscribers.
And they're only really valid for when it goes out. People often ask me, oh, look, can I have access to the back catalogue? Well, it's irrelevant. The back catalogue's completely irrelevant. What matters is what's the next report that's going to come out. Because
two a month.
Once on roughly the 1st and roughly the 15th. Sometimes it's the 30th and the 14th, or depending on the weekends and what's going on. But typically they go out after market on that ish day. But they are timely. They're designed so that I can read that report and without having to buy it on Monday morning or straight away afterwards. Take some time, do some extra work on it, have a think about it, and think about how it might fit in your portfolio. And then if you decide that you do want to buy it, well, you're only competing to buy it with up to 200 other people at any given time. I think these newsletter services that go out, it's all well and good to get a tip from someone, but if there's 10,000 people on the list and you're all trying to buy the stock first thing Monday morning, it's kind of pointless. So we're keeping it curated, we're keeping it small. We're keeping it limited to 200 people. You'll only ever have 199 other people who know about the idea and our research thesis at that time. And it gives you a chance to go away, do your own work, think about it, and hopefully maybe you want to buy the stock.
That's particularly important for something like XRF, which is very low volume. Like it's a small company. And it's also everyone that owns shares wants to keep owning shares. So
and we're not trying to ramp it. Like we're not just talking our own book. Like often we own the stocks that are in there, but it's because we genuinely believe in the company and we think there's an opportunity to make money for people there. So we don't want people to push the share price up. What we want them to do is to get a position and make the kind of money that we're making in the small cap fund for themselves.
Yeah, for sure. Love it. All right. Well, we'll include heaps of resources in the show notes and in the YouTube description, including a coupon code to get a discount. I have it on pretty good authority that a good research subscription may be tax deductible. I'll just give the nod to the camera. Check with your accountant, of course. But if it produces income and you've got a portfolio...
It can be producing capital gains as long as you realise them, then that's the same as income on the ATOs from the ATO's perspective.
So check that out. Have a look around. Have a look.
Pricing grandfathered as well. If the prices do go up in the future and you get in now.
We've grandfathered our first price rise. So if you're an annual subscriber on the first deal, you're going to keep that for the life of your subscription. The current deal is $2,500 a month. If you use your
$2,500 a year.
Sorry. If you use your Owen code, you get 10% off.
Yep.
And when we increase the prices, and I'm telling you, all you little raskies now, don't ring me when I put it up to $5,000 a year. And
there's only 70 left.
And there's only there's 20 subscriptions left, and you're all, can I have the old pricing? No is the answer. So it's we will put the pricing up, and if you get in now, you're going to keep that forever.
Yeah, that's a very big thing in the US communities too. Not just for investing, that the prices go up over time to reward the early adopters.
It's literally how we designed it to start with. We were like, okay, at different gates of subscriptions, roughly, we're going to change the pricing. There's been a few logical points to do it so far, but eventually, the monthly subscription will probably go away, and we'll probably only do annuals. Eventually, will be $5,000 or $10,000 a year to be a subscriber. So
yeah,
like
there's you don't want 2,000 people finding out about XRF.
No,
exactly. Just keep it tight.
Keep it tight.
It'll
and
be
make it really valuable.
From the podcast, you guys will not be coming back. You'll be like,
my PA holding will be worth more.
Good.
No, I think it's important to keep it curated and small, because you just can't have, in a lot of these companies,
if
everyone's money's chasing them on the same 2 or 3 days, you all end up paying 10 or 15% more than you otherwise would have.
Yeah, I've seen it so many times. Cool. Well, that's been heaps of fun. Links in the show notes. People, go and check out Seneca. Also, goodresearch.com.au. I'll put links in the show notes. Gents, thanks for taking a trip down.
Mate, appreciate your time as always.
Pleasure. Thank you, Owen.
Thanks for watching this video on the Rask Network. While you're here, don't forget to like and subscribe so you can get videos each and every day on business, finance, investing, and so much more.